Direct equity versus mutual funds. What are mutual funds? A mutual fund is a pool of money from multiple investors who wish to save money by investing. Asset management companies, AMCs, invest the amount in diversified holdings professionally managed by fund managers who have a great track record in investment management. Top 5 reasons to invest in mutual funds with the Tarocchi app. As an investor, you are the owner of the units allotted to you against your investment amount, which represents the portion of the fund that you hold. The increase in the value of the investments along with other incomes earned from it is then distributed to the investors in the proportion to the number of units owned by them, after deducting applicable expenses, mostly commonly the expense ratio, which is a fee the AMC charges for handling your investments. However, the process may not make you feel the same since it requires adequate knowledge, time, willingness, and the ability to take risk and skills. Time spent on research. Stock investing is not child's play. Some individuals take months, years, even close to a decade to get their stock picking right. Because studying a company's balance sheet and P&L statements just scratches the surface of the investment decision at hand. Funds do thorough research and label their selection according to relevant objectives so you don't have to. When we speak about direct equities, one needs to look at historical data, economic conditions, type of industry, etc. Owing to the fact that not everyone can dedicate time to do research, mutual funds, therefore, offer investors the expertise of fund managers. They have years of experience managing funds, practicing under the guidance of mentors. Freedom is abundant when it comes to choosing the stock you'd like in your portfolio. The only freedom of choice an investor has is in picking the objective of investment. However, a fund manager will administer risk management guidelines in place. They are bound by limits on how much can be invested in each stock and sector. Their decision to invest in a particular stock is backed by strong research conducted by them and his/her team members. When an individual investor transacts in stocks before completing the tenure of 1 year, he ends up paying short-term capital gains. However, the fund managers may keep transacting in them at varying intervals. If the investor remains invested for more than 1 year in an equity fund, his gains are tax-free since STT, securities transaction tax, is already deducted. Indirect equity, one can transact freely without being taxed in brackets. Biases are almost tough to negate when one is investing for themselves. It is tough to digest that your research and study were wrong, in case it was. Emotional biases come into being when one doesn't want to exit at the right time thinking they will receive more returns, or even when a stock has reversed to a downtrend and the investor waits thinking it's just a small blip, correction in the path. Direct equity, as we mentioned before, provides the best and highest returns. One can expect returns anywhere between 12 to 15% investing in direct equities. You must have heard the line mutual funds are subject to market risk. Investments eventually boil down to 3 things: risk appetite, time horizon, and investment objective. One needs to decide based on these 3 broad factors. An aggressive investor with a short time period and an objective to buy a phone should not consider investing in equity mutual funds. They should probably consult their financial advisor and invest in direct equities that provide them the capital gains required in the said time horizon.